online. We are multi-family office is quite young, about 4 or 5 years. Actually, I keep on losing track of time. So all I can say is 4 or 5 years, but we've been working really at light speed. So a lot, you see us quite often everywhere, and we are present in Hong Kong, Singapore, and Taipei as well. And then our Shanghai office is supposed to be launched Q1 this year, but because of a virus issue, we postponed it probably to Q2, if not Q3 this year. Hopefully, fingers crossed, things are, China is opening back up. So yeah, so when you say multi-family office, which means, it simply means that, you know, we are taking care of more than one family. So as of right now, we are looking after about 110, 112 families all across Asia, and about 80% of the family are from mainland China. And we have a 6 people in 4 different places: Hong Kong, Singapore, Shanghai, and Taiwan. Obviously, the biggest team in Hong Kong, the second biggest is in Singapore. And then, so like I said, 80–90% are from mainland China. So what does family office does is that this concept is quite new in Asia, but it's not a new concept in the developed countries such as, you know, US and Europe. And family office, generally, it means that we act as a gatekeeper, or like something like butler for, you know. So I always say, right, so what does a family office do? I mean, I always say that, you know, it's just like, if I'm a butler, so when do you need a butler? For example, in Hong Kong, right, when you have a house of, let's say, 500 square feet, you probably need just a part-time maid, right? But part-time helper. But let's say you have a place of 2,000 square feet, then you probably need a full-time, if not 1, if not 2, full-time helper. But if you have somewhere that is about 10,000, 15, 20,000 square feet, then you're going to have a butler who take care of the security, repairman, you know, helper, you know, all these different gardener, all these different things, right? So I think the essence of that is that's family office. And do we have a very regulated environment? The answer is no, but that is one of the problem or potential that, you know, basically what a family office can do is not limited by any job scope. For example, in Hong Kong, right, if you are part of family office business is the asset management, external asset management business. In Hong Kong, we call EAM. In Singapore, we call it IAM, which is the same thing, but independent asset management. With the independent IAM business or EAM business, you're required to be licensed by MAS or if not SFC in Hong Kong. And with the license, it means that you can carry out EAM or IAM business. But that is only limited to what the license allow you to do. But family office means so much more. So I think one of the things is that if you look at some statistics, right? I mean, if you look at people with 100 million liquid asset, okay, let's talk about general. In general, in Asia, the number of people that wealth is being taken care by independent asset manager in Asia is less than 5%. It's 4.7, 4.8, right? It's still less than 5%. In Europe, it's about 15. In America, it's more than 40, right? But if you look closer into it, and people with, let's say, 100 million liquid cash, right? In America, is more than 80%. In Europe, very close to this digit, and in Asia is high in close to 20, but still, you see, right? People with 100 million in liquid cash, 10 in 2 are using independent. The rest of 80, they're still dealing directly with bankers, and that's because a lot of the wealthy, the newly minted billionaire tycoons in Asia, they are pretty new. So, and whereas the people in Europe and America, generally, they are, you know, a few generations. So even in Hong Kong, right? I mean, you look at some of the richest people, everyone has got a family office. If you talk to the top 10, 20, 30 people in Hong Kong, all of them has got family office. And if you see, look at the history, generally they are passing on to the 3rd, if not 4th, if not 5th generation as of right now. But when you compare to people in China, generally they are still in the 1st, going to 2nd gen. So I think that is a big difference. And also at the same time, people at different life stage of their wealth cycle and different, their expectation and their needs are quite different. And in this case, I think in Asia, generally we are dealing with the 1st gen going to 2nd gen, if not still the first gen generally are still around. They're talking about the second and third gen. So I think there's a lot of the passing on legacy issue, and generally it's passing on for the very first time. And this is where it gets very tricky, because once you have the first generation pass on to the second generation successfully, and the second to third to fourth to fifth to sixth is a lot easier because the framework is there. You just need to fine tuning. But rather than then how do I say? Rather than focusing on the third to fourth and fifth issue. So I think generally, if you look at what family office does in US, in Europe, and in Asia, you would think that, hey, why is everyone in the same industry, but everyone's doing different thing? I mean, you would think that, hey, why is a family office doing so much PE in America? Because if you talk to a lot of family office, a lot of them, they are talking a lot about PE deals, right? They are very PE focused. And when you talk to, let's say, in Europe, the tendency tend to be very different, and in Asia as well. So in Asia, then you break it down even to a smaller, like country by country. Let's say Hong Kong tycoon, right? And mainland China tycoon. The attitude is still very, very different. Even though we are of the same people, we are basically in the same country, but the attitude is very different. So, so in this case, every family office, every MFO, I think is very, very different. And for ourselves, we are, our main engine is in Hong Kong and Singapore. So the Hong Kong, obviously, the main source of client are coming from mainland China. And 2 years ago, when we decided, okay, we need to diversify our company, our business strategy. So that's why we set up the Singapore office. 2 years ago, we set up the whole operation, moved to the new office last year. And then we think that, Singapore is going to be aiming in the Southeast Asian market, which is true to a certain extent, but we didn't expect things to happen in Hong Kong. Basically last year, the social unrest and you realize all the rich Chinese tycoons should be coming to Hong Kong, but you realize some of the richest guys, the CFO of Baidu and the Hai Di Lao, all these people, why are they choosing Singapore, right? A lot of it is because of what's happening in Singapore. The government is very family office friendly, I would say. And at the same time, they are constantly coming up with schemes and different things like 13X, GIP, 13R, and even right now the VCC scheme, which the VCC is going to be our next topic. And so I'm not sure. So if, before I move pass it on to my colleague, right? So just a little bit of background. So a lot of our job is to do housekeeping, which means that a lot of our clients, they generally, when we manage a client's wealth, a family's wealth, is involve quite a lot of banks. And I would say onshore, offshore, 20, 30, 40, we have even seen hundreds, right? So a lot of time it's about, doing a lot of housekeeping. How do we streamline the whole process? At the same time, it's about reporting. So, we have to come up with a system that can, aggregate and consolidate everything. Some of the banking assets, some of the non-banking assets, it has to make life easier for the family or the CFO or the operation staff to see what's happening. So that's one thing. Second thing is from the legal aspect of things. I mean, a lot of this family, they have family trusts, they have under different structures, but a lot of them, they like to run the whole family's wealth under so-called fund structures. And before the VCC came about, a lot of people, Cayman was very, very popular. I mean, in the market, I think more than 90% of the family, when they run in a fund structure, is generally Cayman, right? It's very efficient, very cost effective, and most importantly, it is structured in a way that is more scalable and it can be audited because you involve a few third parties such as fund admin, independent auditor, legal advice. So the way you run your wealth is different. So for example, right? For example, we might have a family of 5, parents with 3 kids, right? So my family, right? So, and by the way, this family office, one of the first clients, my family as well. So I have a younger brother, I have a younger sister. So my family is a typical Asian family, right? So my parents didn't believe in anything except property. And we have got bank account, Hong Kong, Singapore, China as well, right? So the way to run this thing is actually quite tricky because in some way it gets very messy. So you got to do housekeeping. But in another way, there will be times when I'm the second generation. When I take over, I want to not just limit to the family wealth, but at the same time, sometimes I want to have joint venture with another investors. It might be one, it might be a few, right? It might be something that the project is going to take 100 million. I might come up with 10, if 5, if not 20, and then the majority is going to come from all the other people, right? But how do I structure in such a way that is scalable? Then I think this VCC or this Cayman fund structure is very popular. And obviously, the VCC concept is something that simply put, Singapore government is very, very smart and very, very innovative and very quick. So besides these Cayman structures, I think last year or two or 3 years ago, there was this CRS issue, which means that I'm not sure if it used to be one of the benefits of setting a Cayman fund is because everything's offshore. So as there's a secrecy, so nobody is very hard to find out. And most importantly, it's not taxable, which means that, in Hong Kong, capital gain tax is 0, right? But in Malaysia, in Thailand, in all these different countries, a lot of times, it is subject to tax. But it used to be for Cayman fund, they simply just don't do anything and don't report it, and it's done. But right now, because of a CRS issue and the substance idea, which substance means that even if I put my all my wealth in a Cayman fund, which is technically offshore, but because my tax residency, for example, I am Malaysian, for example, in this case, Malaysia has got a capital gain tax. So which means that even though my structure is a Cayman structure, but they have the obligation, and I have the legal obligation to report it to the inland revenue in Malaysia, and then hence they're going to tax it. So in this case, I have to so-called land my taxes. They call it 落地, like 落地. So which means that my tax has to land somewhere. And in this case, I think VCC is very, very smart because when you set up a VCC structure, which means that it's a Singapore version of the Cayman structure, and then the tax you are reporting to Singapore Inland Revenue. But what they say is, once this structure is up and running, all you have to do is put in an application for the tax waiver, and then whatever you put in here, we report to Singapore Inland Revenue, and then Singapore Inland Revenue say this is tax-free. So which means that you don't have to report it to anyone else. So in this part, I think I'll pass on to my colleague in Singapore, JD and Sean, who are very, very familiar with this scheme. And obviously Tina will be helping out. And please, I'm going to pass it to you. Hi, JD. Thank you.
Yeah. Hi, everyone.
Hey, JD, there's a big echo. Okay. I think because Sean's is mute or something. Yeah, but
no, I think when you're sitting too close, both you can have the two screens together. Yeah.
Okay. Hi.
Okay, better now.
Okay, great. Okay, thank you, Shiman. Yeah, so over here in Singapore, I have myself, JD, and Sean over here. So like Shiman mentioned, the VCC structure was launched by the MAS in January this year, and we are selected as one of the 20 entities in Singapore to launch the VCC structure. And basically, in a nutshell, this VCC is like the Cayman version of the SPV. And the Raffles Master VCC is already set up. And currently, one of the major benefits is under this Raffles Master Fund, you can have multiple sub-funds. And these multiple sub-funds, you can have various investment mandates. And I guess one of the major benefits is the non-public register and will give the privacy. So over here, the financial statement will not be made public. And besides that, there also the flexibility in terms of the redemption of shares. So there will be the ease of entry and exit for the investors. And you are able to do the payout dividend of both capital and profit to the investors for all these various sub-funds. So basically, it's a Raffles Master Fund, and underneath the Raffles Master Fund, you have multiple sub-funds, and this can be, you can structure to various, the wide range of investment mandates, investment strategies. And on this master fund level, as Chiba mentioned, that the MAS has launched this 13R and 13X tax incentive. So what does it mean is for this master fund, there will be a tax exemption, there will be a tax deferment. There'll be a tax on the fund itself, but it's taxed at 0%. And Singapore has a double taxation agreements with 70 countries in the world. So if let's say I'm a foreign investor, I move the money to Singapore to invest in Singapore, onshore in Singapore, and then I can apply for this 13R or 13X. Basically, I'll be taxed at 0%. So in the past, just now Chima mentioned that we set up a Cayman offshore fund structure so that you to enjoy the tax benefit. But because of the CRS issue, Cayman is like a taboo word. So in Singapore right now, it's like the Singapore government is welcoming all the funds from overseas to Singapore so that you can lend the tax substance over here in Singapore to enjoy this tax benefit. Yeah.
Sorry, can I just add on one thing, JD? If I put it in a very layman term, right? So a lot of Asian family, they have onshore, and let's say Malaysia, take the case of Malaysian, right? A lot of Malaysian client families, they have, obviously they have a lot of accounts in onshore Malaysia, right? So, you know, they have a family of 5, for example, to probably 10, 20, 30 of the accounts. And generally Malaysians, they do have a lot of offshore private banking account in Singapore, some in Hong Kong as well. So to better run it more efficiently, 5, 10 years ago, they would set up a Cayman fund and run it for 2 purposes. One of them is more efficient, you know, it's more scalable. Second is a tax issue, which means that your tax is gone. But with CRS, which means that right now it's by law, you have to report it somewhere, which means that, so there comes another enhanced version. We call it a VCC, but essentially it's the same thing. Basically, Singapore government copied the whole thing and make it a Singapore version and make it better. So besides the secrecy, at the same time, they will say that, you know what, you are subject to Singapore tax, but Singapore tax is 0 for this case. So that's why I think the whole VCC is quite a big thing in the market at the moment.
And this is Tina, hello. So I'm the head of strategic partnership at Raffles. I can share a few more benefits of having a VCC, or actually a lot of our clients or prospects, they've been comparing, you know, apple to apple, the pros and cons between, you know, a Cayman fund and a VCC fund. So just a quick summary, actually they are literally the same structure. They can, you know, as like it can be a standalone fund or it can be an umbrella fund. Standalone fund means that, okay, just one fund structure and then holding, you know, whatever PE or liquid asset, but it's standalone, one mandate. An umbrella fund means that it's like, you know, a mother and son relationship. Mother at the top, you set the mandate of very broad. It can be a VC, it can be like liquid asset, it can be real estate or anything. And then underneath, you can set up different sub-fund, and each of the sub-fund, it is actually very segregated, meaning that, okay, if one, let's say one sister or one brother or one family member is in charge of one sub-fund, but unfortunately that sub-fund is losing a lot of money and they decide to close it up, it wouldn't affect the balance sheet of the other sub-funds. And then one of the good thing about VCC is that typically, if you guys you know, are familiar with the you know, the investment world, so like the private equity investment or real estate investment, usually it has a period of time, right? The investment period could be rather long. So usually we would put it into a closed-ended structure. And then for the liquid strategy, meaning you buy stocks, equities, bonds, and all these FX things, it traded like, you know, more frequently. So it would be under an open-ended fund structure, meaning you can come in and out anytime you want. And under this VCC structure, actually it can entertain both open-ended or closed-ended structure. And it can also hold onshore, meaning, you know, like Singapore assets, or offshore asset, meaning you can park the Hong Kong thing in, or Malaysia thing, or your I don't know, like Indonesia bank account under the VCC structure as well. So for some family, it can be quite efficient, or for them, it's much easier to manage under this structure. And you can also set this investment committee under each of the sub-funds. So for instance, some family members, they might be good at real estate, so they can be appointed as the IC member or the decision maker of one fund, and the other, let's say they can appoint someone professional like Chiman or anybody, the banker, to handle the the liquid asset strategy. So it's very flexible, and like Chiman or JD mentioned, the tax scheme and everything is actually very attractive. And if you hit a certain amount of so-called the asset under management, let's say over 50 million Singapore dollars, you can apply for the 13X scheme. And if you hit over 200 million, you can apply 13R, which kind of guarantee to have like a residency in Singapore.
PR within 9 months.
Yes.
Yeah.
So all these little things, we see that is actually quite, comparing to the Cayman structure, is quite attractive. And in terms of costing, the setup cost and annual platform fee, we see that for the Singapore side is slightly, I would say they're pretty much the same, but then Singapore, I think because they're pushing it quite hard, so we've talked to quite a lot of professional parties, and their prices are quite friendly as well. And other than that, I think one more thing to note is that actually the distribution, dividend distribution can be made from the VCC capital, meaning, I'll just give an example. For instance, if we are managing a Malaysia client's account, so if we have a Malaysia, let's say private company being the ultimate beneficial owner of this VCC, if we happen to make money within this VCC structure, the profit can actually, pay a dividend back to the Malaysia company, or you can set up an offshore company, meaning Hong Kong Investment Limited Company or Singapore Investment Company. Those profit can be deemed, offshore. So for some, family, they want to allocate a little, distribute some of the onshore asset to offshore, you can leverage in this structure or this kind of thing as well.
Yeah. So I think if I put it into even simply kind of explanation, right? Okay, like we mentioned earlier, generally the family, let's say a Malaysian family, right? They have onshore, they have offshore, right? And besides onshore, offshore, they have liquid asset and they have their business, right? So the way to run the existing business, the family business, and to run the onshore liquid asset and the offshore liquid asset generally are very different, and you involve different people. And the kind of governance, that means the way to run it is very, very different. So for example, right? For example, if a very typical Malaysian family has got onshore business, for example, just like, in China, right? A developer, all right? A property developer. Obviously, they have their developer business. So to get people involved running this developer business, it might be part of the family. It might be part of outsiders such as professional parties, or it can be even other investors that come into the fund as investors, co-investors into the fund. But let's say for the liquid asset, then it's generally, it belongs to the whole family, right? But the thing is, because 5 family members can have like 30 accounts. And this is where it gets very, very messy, because 30 accounts generally, it means that, you have 30 different relationship managers, and 30 different relationship managers tell you to do different things. And onshore banks and offshore banks, because the trading platform capability, they tend to tell you what they know and what they have, right? So in this case, generally we will segregate into different mandate under the master fund, so that, let's say there's a fixed income, there's an equity, and there's a, let's say, FX fund, right, which is very typical arrangement. So for fixed income, generally you have 1 or 2 fixed income portfolio managers. So for example, my firm has got 2 portfolio managers, right, fixed income. So either Lawrence and let's say Daniel is going to sit on the board, right? And obviously a lot of the family members are going to get involved as well. So to run this fixed income mandate is very efficient, and the whole family's asset that is in fixed income is all put into this thing, which is properly run, I think, in this case. And then for the equity part, very likely you don't want to get my portfolio managers for fixed income to be involved, because you want somebody who specializes in equity, right? So probably equity, and at the same time, you might think that, the family might think that, I have a family member, somebody I trust, or maybe a professional party, maybe somebody from other bank, that I want to get them involved as well. So indeed, they can be on this committee. So, which they meet up every quarterly, if not every semi-annually, so to review what's happening. So if everything's going on and, constantly we are in line with the benchmark and we outperform benchmark, that's good. But if, let's say, something's wrong and we are not, for some reason the performance isn't there, then maybe some changes need to be made. And that is all being done at the board level, which means that, so I think in this case, it is all about, it's not so much about this, is this an end product? No, but it is the way you structure and the way you run your family wealth in terms of the real business and the secondary market side of things. So I'm not sure if, because this is a very short period of time, we only have like 20-30 minutes, so it's a lot to squeeze in. So feel free to ask any question you might have.
Just to jump in, to share one more trend that I see it, because so personally I came from a family office background, and then I realized that, I'm not sure in other places, but in Hong Kong, doing club deals, co-investment, direct investment among the friends and the so-called the community is getting more and more popular, because back then they would just listen to their bankers or listen to whoever. Okay, I'll buy this PE fund, or I buy this whatever VC real estate fund. Nowadays, people get to know each other. I mean, the world is small, right? So maybe they will run into their friends developing this, Sydney project, and they'll be like, oh, okay, I'm interested. And you know what? I have a few of my friends who would be interested as well. So, doing the club deals with investment, you can also using this, fund structure as well. Just have a sub fund, and then because one fund you can separate into different share class, meaning if I'm like, for Chi-Man, if he's my best friend, I would be like, okay, I won't charge you any fees, just pay me performance fee, or I'll charge you nothing. And then a different share class, which is to my cousin, I can charge him like with the separate terms, like 220, 110, whatever thing. So I think it's quite a flexible ways to do this once you set up the VCC or Cayman structure, and then a lot of things that you can play around, within the fund, framework.
Yeah, I think in ASEAN, right, Southeast Asia, a lot of I realized that in Malaysia, not just Malaysia, in Thailand, Indonesia as well, a lot of the second gen, they have their own idea because of the education background, because of different aspiration. So the tendency is that the second gen tend to have their own fund. So I realized that a lot of the second gen, they have their own fund, but they run it totally separate from the family, which, in a way, good, bad, I don't know. But generally, I would say that it will make more sense to build under when you set up a master fund for the family. But the PE fund, it could be part of this fund for two purposes. One, the management is better. Right? It's, like I said, the government is better, but at the same time, imagine when the second gen, when they set up a fund, brand new fund to pitch to others, right? Instead of, it's a brand new fund which has got like 20 million, and which is, the case for one of the Thailand fund that we're dealing with, right? So it's not easy to pitch for funding, but at the same time, if you are part of this master fund, part of a family, first of all, it's easier to switch the funding from, let's say, one SP to other SP, because it's part of the fund together anyway. The second thing is that when you pitch others, it's part of this family office fund, that your family office, which is always a lot more solid, because people see the commitment. You know what I mean? So instead of, oh, you know what, I'm from a rich family, but this project I'm working on is a side project. So people, sometimes you're not sure, but if, let's say, my family is your master fund, let's say the Kwan family master fund, and yeah, this is SP5, and I have this new idea, new concept about tech thing in Hong Kong, right? And I'm putting $10 million in. So when people see that, and they are very comfortable putting another $10 million in, so in this case, sometimes it is for branding and funding purposes as well. So yeah, there's a lot of so-called benefit of using this fund structure, be it Cayman or be it VCC. But generally, I think with the VCC now, it's quite a no-brainer.
Just one last point is that also a lot of our the family members that coming to talk to us, one of their key concern is privacy issue. So unlike a company, actually VCC or not so much about Cayman now, but VCC protects the privacy of the shareholder, meaning that unless there is like, a court order or something, other people cannot tell or they can't find out who are the shareholders, of this VCC master fund or sub fund. So yeah, what should we do the Q&A?
Yes,
JD, Sean, you guys have anything to add in right now? If not, we can do a quick Q&A session.
Yeah, let's go for Q&A.
Yeah, so basically we share our screen. So this is our short write-up, one-pager write-up on the VCC. So we'll send it to you guys later.
Yeah. Feel free to ask any questions.
Can I ask a quick question? So what's the difference between a single family office and like you guys have a multiple family office?
Sure. Yeah. Family office, I think the first differences is single and multi. I think single, obviously, in terms of why do people have single family office and why do people have multi-family office? Okay, so if let's say I'm from a good family, right? So I can either choose to open a single family office and use a multi-family office. First thing that comes to my mind is always the cost, because if you want to run a single family office, generally the cost in Hong Kong, right, it's not cheap. 4 to 5 people, so one accountant, 2 traders, or one somebody, an investment manager, and somebody who run the office, right? So generally about 4 or 5 people, you are looking at about $1 million a year, the running cost. So if you have 100 million and your return generally, let's say, is 5%, 8 to 6%, right? Or in a very conservative portfolio, then a lot of the return is actually going into the cost, which is quite high. But if let's say 100 million, and then we engage a multifamily office, generally the cost is about 30, if not half of it. So in cost-wise, it makes more sense. So that's one thing. So we always say that, when should you start thinking about having a single family office? I would say that in Hong Kong, you should be looking at about 250 to 300 million before you should consider looking at a single family office. But at the same time, right now, because the things are happening so quick in the world, right? And sometimes the funny thing is, we deal with we are multi-family office, right? But actually about 10% of my client, they are single family office, which is very funny, right? They have their own family office, but why would they want to? Okay, one of the family office has got 300 million based in a Chinese family office based in Hong Kong. They have about 300 million AUM, US dollars, and they outsource about 50 million to us simply because they want to diversify the, let's say, of the 300 million, 250 are in fixed income, which is basically doing bonds and nothing else, right? And they want to diversify 20% of it to us. Let's say, I do know that they diversify 20% to fund houses as well, some, BlackRock, PIMCO. So a lot of times they want to diversify their portfolio, diversify the risk, and even though they might have their single family office, sometimes they don't want to have, everything very concentrated, because basically if the that one person investment manager make the wrong call, then they could be in trouble. And like everybody understand, I think there's only free lunch in the world, which is diversify your portfolio. So I think a lot of times cost issue, diversify, it still makes sense to have a multi-family office, even if you have a single family office. But when you have 100 million, 50 million, it simply doesn't make sense to set up a single family office.
And just to add on, some of the reason for them to join MFO like Raffles or other players in the market is that they realize the network is quite essential. You know, single family office, of course, you have, again, your bankers, your friends, but when you want to explore other, let's say, deals or investment or strategy, tapping into a MFO network that is very efficient. And also for sometimes like fundraising purposes, because they get to know more about, you know, other family office or clients, what they're doing. And with us, we sometimes we do co-events, you know, to let, you know, parties to meet each other, something like that, to share actually what's the struggle within their own, you know, family. Yeah, so that's my...
Yeah, I mean, just a real life story, right? One of my client is owns a financial company, listed financial company in China. And he started, I mean, this is something that he has done for like almost 20 years, but for the past 10 years, a lot of his wealth actually accumulated from property investment, and he do a bit of property development as well. 2-3 years ago, he decided, okay, I'm cashing out on the property side. So he said, okay, I'm cashing out on all these things. So when we manage wealth, first of all, a lot of it is very, very conservative. And second, he wants to avoid the property market. But he does want to diversify into Thailand, which is the Thailand property market. And so happened that one of our clients is one of the richest guy in the, you know, not property market, but in another market, but he does have some exposure in property development in Bangkok. So we kind of introduce them together, and this is JV happen, right? So I think sometimes things like that, in a way, it is not so much about I manage your money and, you know, instead of 5% return, you get 6% return, right? I mean, not just that, but rather sometimes around network as well. And also to extension to May's question, right? Besides whether you should set up a single family office, multi-family office, I think if you take one step backward, why would you want to set up a family office which costs you some money to set up or run? I think the biggest difference here is that instead of dealing with bankers, and when you set a family office, you have a set of bankers that are standing on your side of the table. Let's say there are two sides of the table. When I sit with my Bank of Singapore banker or UBS banker, right? In a way, they are always thinking on UBS behalf, right? How to maximize the revenue on behalf of UBS. But when you have a family office, let's say I'm from ex-UBS. When I am on your side, the way the deal that we think of is the way we structure some of the investment product and strategy is always to the benefit of my client, of who I'm representing, which is the client, right? So my first priority is always the family, right? So in this case, we are on the buy side rather than on sell side. But when you deal with bankers, you are pretty much on the sell side, because there's always a conflict of interest. Because let's say when you put $10 million in UBS, right? Whether you make money or not for each trade, it's not really UBS top priority. I mean, obviously they will claim to do so, but most of the time they only care about how much money, the commission they're gonna get out of this deal, right? But let's say with us, with family office on your side, generally family office charge on a management fee. We don't take a commission. So in a way, to me, to the family office, whether you do 1 trade or 100 trade, it is, to be honest, it's no difference, right? But I do want to maximize, because the relationship is for the long term. At the same time, family office, a lot of time, you know, for certain mandate, we have performance fee as well. So in order for family office people to maximize their return, sometimes they have to get the best performance rather than doing more trade. So I think that is the ultimately one of the most fundamental issues. That, I mean, I'm not sure if you recently, you have any bankers friend or you deal with banks, right? Recently, one of the biggest things is margin call. Right? So I'm not sure so one of my, before this, I actually got on my phone with one of my main clients. So he's got 150 million with me, and he asked me, hey, my 3 mandate under the 3 fund, under a master fund, do I have any margin call? And I said, no, we don't have any margin call. And he was surprised. I mean, like everywhere, every bank, and he does work with other investment companies as well, and banks. And he said, hey, everyone is asking, is getting margin call. Why did it? I mean, if the banks cut out loan to value ratio by 30%, then I should be in trouble. I said, yeah. Okay. So the strategy we have for sure, beginning of actually last year and this year, was we leverage about 30%, which means that if you have $10, I'm going to invest in $13 of investments, even though I could have gone up all the way to 160, even $200, right? But the reason being, in the long run, statistically, it shows that 30% is actually very healthy and it maximizes return, and you know it is good. But if I am if I'm a banker, that I have full control of the portfolio. Obviously, from the $100, I want to leverage up to $300. You know why? Because that means I can take commission of $300, right? But when that happens and the bank cut LTV ratio, straight away, the first thing that happens is margin call. And obviously margin call, if we invest into like, a conservative product that due to, and when it mature, I'm going to get my capital principal back, then it's very simple. I just, put some money in to top up the margin call, and that's it. But the thing is, normally they leverage in such a way that they have to deleverage, which means that they have to realize the loss before things get back to normal. So unless you can come up with the money within 24, 48 hours, which means you top up the money so that there's no more margin call, or you have to sell off, which means you realize the cost straight away. And generally, that is the thing that hurt clients' portfolio the most, which when you over leverage, even though when you invest in very, very high investment, high quality yield product, but when the LTV drop, that over leverage is going to kill you. So I think the key thing here is that when you have a banker who's acting on your behalf and their best interest of you, generally over leverage is definitely not recommended. So let's say in our case, right, generally the mandate is we never go above 50%. If you're $100, we never go above $150. But generally on average about 130 to 135, that's our range. So we always advise the client, and some of the client, they are quite investment savvy, especially from Hong Kong and Singapore. So generally we'll say that, okay, if the main portfolio 80% in fixed income, we will stick to our advice. But let's say the $10 or $20, if you want to do crazy leverage, that's fine, but we do it in another mandate. So that just in case this thing, something happened really bad, even margin call, you get liquidated, and it doesn't affect the main portfolio. So I think here the key message here is that you have to have somebody to act on your behalf and in your best interest, and generally it comes in the form of family office, whether it's single, whether or it's multiple. Yeah. Okay. Any more questions?
There's one chat. Oh, okay. Yeah.
No, we can take it offline.
Yeah, otherwise we can take it offline for the interest of time. So meanwhile, can send you guys some of the materials that we shared on the screen just now.
Yeah, if no more question, everyone's good, or just overwhelming.
It's a lot of
I mean, yeah, it's a lot of information, so I think everyone need a little time to digest. And yeah, we'll in touch with if anyone want more information, can talk to Chiman. Yeah.
Okay.
All right, sure.
All right.
Everyone.
All right, thank you.
Thank you.
Thank you.
Bye-bye.
Bye-bye.
Thank you, everybody.
Bye.
Stay
All
healthy.
right. Thank you, Chiman. Thanks for taking your time. Clap.
Bye.
Bye-bye.
Thank you.
Bye.